What is redraw versus having an offset account? Now, they both have the same effect on the amount of interest you pay on your home loan. However, they have one massive difference when it comes to tax time and how those debts are viewed in the eyes of the ATO. Hi there, I'm Nick from the Lending Lab, and today I'm going to talk to you about redraw versus offset account. So first of all, what's the difference between an offset account and redraw? So an offset account, it's a separate account that's attached to your loan and it allows you to reduce the amount of interest that you pay based on the difference of the offset account and the home loan. So for example, you have a home loan of $500,000 and you put $100,000 into your offset account, you only pay interest on the difference. So you pay interest on $400,000. Now redraw is when you make loan repayments or additional contributions above and beyond the minimum amount required per month into your home loan. So in both of these examples, they have the same effect, you only pay interest on the $400,000. So why are they substantially different then? Well, it comes to looking at them from a tax perspective. So let's say, for example, you want to buy a new car, you want to save up, you want to pay cash. So you save the money, you put it into the redraw of your investment property loan, so you're saving on interest. Now, we want to go and buy that car, so we pull the money back out. So technically, we're re-borrowing those funds. Therefore, those funds, instead of being viewed as investment, they're now viewed as personal. So for example, you have Homer and Marge. They've paid off their home, they have an investment property with $500,000 currently owing on the home loan. You want to purchase a car, so they save up $50,000 into the redraw. So at the moment, they've got $50,000 in the redraw, and they're paying interest on that $450,000. Now they go and they buy the new car, they spend the 50, transfer it out of the home loan, and now they're paying interest again on the full 500,000 because they've spent the 50. However, because they took that 50,000 out of that investment loan for a personal purpose rather than an investment purpose, they may not be able to claim the interest on that $50,000 on their tax return, even though they're still paying that. So that's a big difference. Now the way to work around that, if they had put that money into their offset account, technically the same thing would have happened. They would have saved interest on the 50,000. However, when they pulled the money back out, they hadn't technically reborrowed because they haven't touched the physical loan itself. So the entirety of the loan may remain tax deductible, and that's why it's important to have the difference between the two. Now, you must seek professional financial advice around that. This is just general advice and it doesn't take into account your personal circumstances, and it's not to be used as a substitute for obtaining professional financial advice. But that is why it's important to use an offset account rather than redraw. Same effect, however, different at tax time. If you have any questions, put them in the comments below. Otherwise, don't forget to like and subscribe. I'm Nick from the Lending Lab, and we'll see you next time.